Yo, what's up people? In today's video, I wanted to break down how to trade strictly from the higher time frame. In my last video, I shared about how people get caught into the trap of just thinking you need to trade the 1 minute time frame, and the lower time frames are everything. And if you find someone who can trade the lower time frames and make like 20, 30, 40 R a week, then that person somehow is better than the other person and you should follow them because they can make crazy returns. But what I tried to share in the last video, I'll break down really fast, is just that because someone's trading lower time frames, they're taking a lot more losses. And because they're taking a lot more losses, they're typically using 0.25% risk. Whereas someone like me, I can risk 1% if I'm just trading the higher time frames. So I'm making 4 times what they're making. So let's say every week they make 40 R, which is pretty high, fucking really high. Let's just say that every week they make 20 R. Then that means I only need to make 5 R for that week to be making the same amount as them. And it's less risky and less work. And what I'm trying to say is that the market is fractal. So it doesn't matter if on the 1 minute you're following a bullish trend and you're trading these, demand zones, and then price goes bearish and you're trading these supply zones, right? It doesn't matter if on the 1 minute, this same thing happens on the higher time frame. It just takes more time for it to occur. So the same thing's happening, right? We're having bearish trends and then price goes bullish and then price goes bearish. So it's like the same thing's happening on the higher time frame. It just takes more time. So if you're okay with, if you're okay with just setting orders and just walking away, you're going to get less trades a month, but you'll still make similar amounts with less work. So you can go and do shit you want to really do. And so, yeah, that's what I wanted to share today is how you can trade the higher time frame strictly, because someone was asking me the other day on the video if I can make a video about how to just trade the higher time frame. So there's a few different methods for doing it. I'm going to share with you multiple methods. The reason I want to share multiple methods is because I don't want to just tell you what to do. Anyone that tells you what to do is just trying to sell you some bullshit. Some people view the markets a different way. Some people want to be a little bit more active. Some people want to be a little bit more passive. You have to figure out what your personality is. So in today's video, I want to share that. So one of the ways is strictly just following structure on the 1 hour and waiting until you get a momentous move. What's a momentous move? Something that has imbalance is clear. So like this move is not momentous. Like it is strong, but there's not a lot of imbalance and it's very wicky and looks confusing. Whereas like this move, you can see there's imbalance and inefficiency here. So there's a reason for price to want to come back. And so what you could do is just literally use this whole block. So this up move before the down move, you could just place an order here with a 20 pip stop. And your target is always going to be the low, right? It's always going to be this low, because if price is bullish, or sorry, in this scenario, if price is bearish, right? These highs should be protected. So where's the next liquidity point is here, because these should be a weak low. So when price comes back and goes here, that's your next target. Oh, sorry, your target should be here. I don't know why I just said that. So my next target would be here for 1%, which doesn't sound like a lot. And again, it's not that much, but when you do this enough times a month, and the fact that because you're trading the higher time frames, you don't have to trade just one pair. Like for me, when I trade the lower time frames, I'm only trading euro dollar. But if I'm trading multiple higher time frames, I can trade pound dollar, pound yen, euro dollar, and USD yen. I can trade all those pairs because I'm trading the higher time frames. So I'm just waiting for one thing. And so, yeah, you can use this method. The other method is to use the full up range before the move. So you would have your order here targeting the low, or to use the 50% of that, or to use the 50% of your demand or supply zone. So whatever you want to use. So in this scenario, you would miss your entry. Now there's another scenario where if you want to be a little bit more active, but you don't want to be on the 1 minute and you don't want to be like wasting time looking on the 1 minute and scouring the 1 minute, there is a method I'm going to show you right now, which is also really potent. So let's say price comes into a demand zone, right? So price goes bullish here, right? What you can do is you can go to the 5 minute and look for a confirmation. So this is a confirmation which allows you to wait for price to confirm before you get in. So you save yourself from taking unnecessary losses, but you do have to be a little bit more active, where the other one, it doesn't matter what time zone it is. You can just fucking enter whenever, as long as it's not spread hours, or as long as there's no like major fucking news like NFP or FOMC. Anyway, so in this scenario, you have to be a little bit more active, but it's better than stalking the charts. You can just set an alert here. So as soon as price comes in here, you start watching and you're like, okay, this is my range. You set an alert here, you just walk away. You wait till price breaks this high, and that's when you come back to look at the charts. And then when you see that, you see, okay, cool. There's a few ways to enter. One is to enter as soon as price comes back to tap this previous high. So as soon as price finds support on here, you have an entry here and you go. Another way is to take this is the one that I like, is to take the full up move and use 50% of that. So the full up move, use 50% of that, place your order here, and then have your stop either below the full range or below this. So I like to use below the range, depending on the stop size. Like for this one, because it's under 10 pips, I'll just have it below the range in case price comes back down to tag lower. So price rips, it doesn't break this high. And then what you do is as soon as price breaks this high, then you move to break even. Now this wasn't really a proper break, but yeah, so you would get tagged out. Maybe you need to break even, but who knows? I probably wouldn't, because again, I'm trading the higher time frames. Now let's look at another example. So we're following the trend, right? Price is bearish. Price comes into this big demand zone. Now you could just use this, like I told you, right? You could use the full up move. So you could just be like, yep, I'm gonna enter here with a 30 pip stop, and my target would be down here for 1.5 pips. That's one way. Another way is to wait for price to come in and give you a nice breakish structure on the, like an internal breakish structure. Because this is such a big range, I would look for internal structure. I'd wait for it to tap this zone and I'd wait for it to break. So what you see is, like, you see this kind of like internal structure here. Price then breaks, right? Momentous move. It breaks like multiple structures. That's how you know, okay, cool, it's confirmed. Now this could be your new zone that you look to enter. Now again, it was a strong move. So what you do is you could just enter straight off the 50% of that, targeting, your first target would be here and your second target would be here. And then look at that, you make fucking 5% minus the 3% you partialed, so you probably make like 4.5%, which is fucking awesome. Now let's say you didn't do this and you entered on the full candle, you'd have a 15 pip stop, 3%, boom, easy. Or you do the 5-minute method, which I was just showing, you might not get an entry. Sorry, this is old shit I have up here. So let's see, would you get an entry? No, you wouldn't. Price just never pulls back, right? Because you're looking at this as your range. Price comes and it never pulls back. It pulls back, yeah, you literally just barely get missed if you were to use that one method where you use the support. Like you would maybe get in, but maybe not. So again, there's pros and cons to every one. One takes a lot less time, but you'll take more losses. Like you would just take a loss here. This one takes less time, but therefore, you know, you can take more losses, or you can drill to the lower time frame and you'll miss the entry. Or you could use the 50%, which you'll also miss entries, but you'll have 50% less stop loss size, which means your reward is double. So when you do get an entry, you get double the reward. So it's all about how often you want to trade, what you want to look for, etc. So if we keep looking, price breaks this low, so that's your low. I would almost really say this is the structure now, just because again, that's such a big ass range. Cool. And again, this is really ugly, so I'm not gonna like look for anything here. And then price breaks higher, so now you're looking at, okay, cool. And again, you just wait for something clear. If it's not clear, then don't enter. So like this one is clear, I would look for an entry here. Now again, both methods work. Notice how the one method, demand 1 hour, this method, you would take a loss, right? Or if you use the 50% of the whole thing, you would take a loss. But if you use the other method where you wait for the 5-minute, you don't take a loss because there's no entry. Price comes in, doesn't really give you anything, right? This is not a break. This is not a break of structure because this never broke the low. So again, this is your trend. And we never break the high. until here, but we already broke below, so I'm not looking at that. So you would have one loss on the higher time frame, but if you waited for the confirmation, you wouldn't. So it's all about, like, everything has pros and cons. There's, like, you know, there's benefits and drawbacks to both things. You have to be able to see both sides. You know, that was one of the main things I saw with when I was working with my trading coach, my trading psychologist coach, Pat Baylooney. He always said to me, like, there's benefits and drawbacks to everything. What happens is when you take a loss, what happened is you had an expectation about what you thought was going to happen. And that expectation caused you to have anxiety and caused you to be mad when it didn't work out. Which the same thing is your brain is failing to see how there's benefits and drawbacks to everything. There's benefits to that loss. That loss is going to teach you to stick to your high probability entries. It's going to make you look at your trading plan and make sure it's proper. It's going to cause you to do a lot of things. Like, that loss is good. That loss is not bad. It's only bad when you have an expectation that losses are bad. And so you need to work on understanding that losses are inevitable and they're okay. Like, there's lessons to be learned from both. There's neither good nor bad. Same thing with this. There's neither, like, people will look at the 1 minute and be like, that person made like 40%. It's like, yeah, they made 40%, but they're risking 0.25% because they take like 5 losses sometimes in a row. And that's okay though, if you're okay with that. But some people aren't. Like me, I don't want to take 5 losses. So I'm okay with doing this. If the losses are spaced out over days, because my brain can handle that, I have time to sleep on it and not worry about things. Also, I don't have to be as active on the charts. And so there's benefits and drawbacks to both. What happens is your brain doesn't want to see the drawbacks. And so I'm not going to go really in depth in it. If you want to learn more, just comment below and I'll link to the channel of the guy that I watch. But yeah, anyways, let's continue. Yeah, so this was my trend. And then now we just broke the low. I'm not looking at this because it's fucking ugly. Just waiting. It's really just ranging. Like, I'm not trading any of this until we get a proper break. Okay, so we get a proper break there. So this is now your trend. Sorry, this is your trend. And you could look for an entry here. Oh, would you look at that? So if you had the 50%, you got missed. But if you had the proper entry at the top, maybe 15 pips stop, and then where are you targeting? The high. Watch us get missed. You're at break even now, so it doesn't really matter. Yeah, so you would take a break even on this trade. Maybe you took some partials at this high. Who fucking knows? Let's see if there's a 5-minute entry. I doubt it. Doesn't look like it. Oh, there is. Look at that. So if you had the 5-minute entry, boom, price goes. Either use this as your thing, stop below here, or sorry, let me just delete this, or you use the full up move, 50%, stop below. You could either have it below here or here. I'd probably say below here, but let's just say here. And then your first target would be probably on the 15-minute or something like that. Yeah, so this high could be your first target, and then this is your second target, which it doesn't hit for partials. So yeah, and then you get taken out for break even. See, there's benefits and drawbacks to both. Like on this one, you were able to get a partial as well as it's higher RR. This one, you just took a break even. And then the 50% one, you don't even enter at all, right? So there's benefits and drawbacks to everything, and you have to just be able to identify that. Like, okay, this, you took a loss. So that's -1. This, you took +5, +3% for the partials. So you probably got like, 4R, so 4%. And then this one, you got a -1. And then this one, you got a 0. So you're up 2%. Now, the amount of time that this happened, what is this? This is 15 days. So over 15 days, you got 2%. But this could happen on multiple pairs, as well as there's more trades that are probably coming, right? Now, if this happened across 5 pairs, that's 10% for the whole 15 days, times, the whole month. That could be 20% a month. That's crazy numbers. That's enough to pass your FTMO. And so what I'm trying to say is, like, you don't need to trade the lower time frame. You can just trade the higher time frame, is what I'm trying to tell you guys. So yeah, in that video, I just want to share that. Let me know your thoughts, comment below. And if you want to learn more about some cryptocurrency stuff, where I learned how to trade crypto and not this Forex. Forex is different. If you want to learn where I trade crypto, check the link below. You can join this community where I learned to trade crypto. They also teach you things about like copywriting and marketing and all sorts of different things. So yeah, if you want to learn more about that, click the link in the description, and I'll catch you guys later. Peace.